Do you want to be ahead of the game for the latest in arts, music, cuisine, and entertainment across the Middle East's most dynamic capital cities? Al Monitor is proud to launch our City Pulse newsletters, focused exclusively on local news, starting in Riyadh, Dubai, Istanbul, and Doha. Each week, our on-the-ground writers in these cities cover the latest cultural happenings and trends, so you have everything you need to know for the best local experiences. To subscribe for free, go to almonitor.com, that's al-monitor.com, and sign up on our newsletter page.
Welcome back to the Al Monitor Brief. I'm Adam Lucente. 2025 was a big year for the Middle East economy. We saw continued effects from the war on Gaza and new impacts from the Israel-Iran war, not to mention a number of technology and energy developments. In this episode, we'll be reviewing the year with Al Monitor's business team, Sam Wendel and Jack Dutton. Listen as they delve into a number of topics, including the return of shipping companies to the Red Sea after a downturn in the Houthi attacks, why some observers believe oil will stick around for longer despite the renewable energy push, and how the Gulf fits into the U.S.-China competition for critical minerals. On the tech side, we'll go over the state of the AI race in the region, why startups raised more money in the year, and more. Hope you enjoy. Okay, Jack and Sam, welcome back to the Al Monitor Brief. It's good to have both of you here to unpack what was a big year in the Middle East and North Africa politically, in terms of various conflicts, but also on the business front. Jack, I want to start with you. What economic and business developments stood out to you the most in 2025?
Sure. I mean, it was a very eventful year. We obviously, on the political side, had some major wars, including the war in Gaza, which carried on. And obviously, there's the fragile ceasefire. And we had the 12-day conflict with Iran and Israel. And that obviously had an impact on markets in the short term. And you could see that oil prices were hit in those days during the conflict, especially during the Iran conflict. But the general trend was that oil prices continued to tumble over the year as OPEC, the Organization of Petroleum Exporting Countries, which include a lot of Middle Eastern countries, Saudi Arabia being the key member, doubling down on production and causing an oversupply in the market, and demand not recovering quite as quickly, especially from China. And when you look at some of the projections as well from the International Energy Agency and OPEC, they kind of predict an oversupplied market. Another watershed moment in the region was the change of power in Syria. The country has been trying to recover its economy, which the World Bank estimated will cost at least $216 billion in damage to repair. So there's a lot of challenges there, but the leadership have been quite intent on trying to lift some of these economic sanctions and spur foreign investment in Syria. Also, foreign investors this year have looked at a lot of different energy projects in the region, including giant renewable energy projects in the Gulf countries. In particular, we've seen the likes of Aqua Power invest heavily in renewable opportunities, including not just in the Middle East, but also across North Africa as well. So that's been one of the trends. We've seen an increasing non-oil related trade from some of the richer economies in the region, like the Gulf economies, like the UAE and Saudi Arabia, as they look to try and diversify their economies away from oil by investing in other sectors such as clean energy, entertainment, and AI.
And Sam, in terms of the technology topics that you look at, what developments stood out to you the most this year?
It's kind of all about AI this year, at least in the Gulf. I mean, there are major storylines across the region, but the Gulf's massive push into artificial intelligence, alongside its growing tech alignment with the United States, has really stood out this year. You know, regional interest in emerging technologies, including AI, is really nothing new. But for years, this was mostly more hype than reality. But this year, we actually saw, or witnessed significant activity here. Gulf states are pouring their oil and gas riches into digital infrastructure, AI chip deals, and as well as launching, new state-backed AI companies and forging new global partnerships. Saudi Arabia launched its own state-backed AI company that earlier this year, and Qatar just a few weeks ago launched its own AI company. So there's a lot going on here. Saudi Arabia and the UAE are sort of leading the pack, but as I just mentioned, Qatar is also kind of making some moves here and is probably going to be more active in 2026. And kind of amid all this, some observers kind of see the Gulf region as positioned to become the world's third AI hub behind the US and China. That status is far from guaranteed, and we're still in the early stages of the AI boom here. There are real execution and geopolitical risks that could kind of undercut Gulf ambitions, but based on what happened this year, there's some actual real progress that needs to be sort of taken into account. And, kind of underpinning all of this was kind of a growing focus on U.S. tech ties and AI diplomacy with Washington, which, Gulf states really quickly showed as soon as U.S. President Donald Trump returned to office that they were going to kind of go all in on U.S. ties here. And again, this is nothing new. We saw major tech deals with the Gulf under the Biden administration too, but this year that relationship sort of went into overdrive. And, that was really on display in May when Trump visited the region, and you saw major deals struck across AI infrastructure, chips, and beyond. But as we also saw, there was some lingering sort of scrutiny over these deals. There are still fears in Washington that China could use the Gulf as a backdoor to access sensitive U.S. tech. But Trump's deal making here kind of, suggests that under his administration, at least, the Gulf states are considered key strategic tech allies here, and keeping them in the U.S. corner is a very important priority at the moment. And so, big picture, though, in terms of all these AI headlines, 2026, we're going to have to look at whether or not a lot of these preliminary agreements can kind of advance to the execution stage or kind of, actually turn into real progress. And, history suggests that not all of these collaborations will, but we are seeing, data centers under construction, chip exports being cleared. So things are going on. Beyond AI, though, there's a lot of other things that happen in this region. And, Jack mentioned Syria, with the sanctions finally hopefully coming off there fully. 2026 could see Syria's tech sector finally start to see some momentum. That's one thing we'll be tracking. This was actually a pretty big year for startups in the region in general. Last year, startups in the Middle East and North Africa, excluding Israel, raised about $2 billion in funding. That was an average year, but this year they're on track to maybe get close to 8 billion. So and that includes debt, but that would likely represent a record year. And also looking at Israel, just I think yesterday data came out that showed that private financing for Israeli tech startups reached 15 billion, up from about 12 billion last year. So you're seeing strong momentum there too. Those are kind of the big stories on my radar this year.
Sam, staying on you quickly, why do you think startups are raising more across the region? Is this simply a matter of economic diversification gaining steam or greater interest in the region? What's behind that?
I mean, there are a number of things kind of influencing it. One is AI. That's powering new investments in the Gulf. At the same time, some of these totals have been kind of elevated a little bit by larger companies raising much larger rounds. For instance, in August, you saw the Saudi fintech company Tamara secure roughly $2 billion in financing. I mean, that's a huge part of that total, but it's also a sign of maturity in the region that you have bigger companies raising bigger rounds, where in the past, a decade ago or so, tech companies in the region did not have the ability to raise financings of that size. And then, turning to Israel, obviously these numbers are still down from record numbers seen earlier in the decade. But, the high tech sector is, an engine of the country's growth. And if you look at a lot of the companies that are raising funding right now, many of them are veterans of, the IDF's elite units. So the war is actually also, I think, boosting some elements of the tech sector there.
Jack, going back to you, one story that happened at the end of the year, just this past week, was major shipping companies returning to the Red Sea and the Suez Canal. We've seen Maersk and CMA CGM re-enter the waterway just in the last few days. How bullish are you on the future of shipping through the Red Sea, especially with Yemen heating up again? And how is the industry looking at that? Do they view this as a permanent return, or is this something more precarious?
Since there's been this fragile ceasefire negotiated in Gaza, there's been shipping companies return, and there's been signaling from the Houthis that they're going to stop the attacks. And indeed, there have been far less attacks now. So Maersk returned, but they did kind of, the Danish company Maersk basically cautioned that it had no firm plans to fully reopen the route, but would take a stepwise approach towards gradually resuming navigation. So it looks like they're going to do this step by step and be quite opportunistic. They're still quite cautious because the ceasefire is fragile. In theory, it's still being held, but actually, when you take a look at the news and what's happening in Gaza, there's still a lot of fighting and strikes. So, although the ceasefire is holding, it's very fragile. So, I guess a lot of the international shipping companies are quite cautious. And when you look at CMA CGM, it's a similar story. They haven't fully resumed all of their services, but they have gone back and sent a few ships. And we saw a similar pattern as well early in the year when there was a week-long ceasefire and you saw a few ships go through again. But when you look at some of the other companies as well, you have there's the German shipping company, which is one of the major ones, Hapag-Lloyd. And in December, the CEO said they were preparing for a gradual resumption back through the Suez Canal route over a 60 to 90-day transition period to kind of ensure safety and logistical stability. Because if they are attacked, it's obviously hugely costly and they want to protect the safety of their crew. But in terms of my outlook, I'm quite bullish that we will start seeing a lot more traffic through this Suez route as the new year and the ceasefire hopefully holds for longer. But obviously, it all hinges on the ceasefire. And if it falls apart again, or if there's any further conflict in the region, the Houthis could easily start attacking the ships again. And there was an article we published the other day which spoke to some European diplomats, which kind of who predicted that maybe Israel might attack Iran again next year. And if that's the case, we might see a scenario where we're going to have some more attacks. But for now, it seems pretty optimistic. And you're obviously seeing some groups, which are shipping groups, which are putting more ships back through that route. But you're seeing other ones like Norwegian group Wallenius Wilhelmsen is still kind of assessing the situation and will not return to the route until certain conditions are met.
Sam, this isn't a tech area, but it's something you've written about, and it's the same geographic area, which is the Egypt-Israel gas deal that was announced this week. What I'm curious is, why are these gas ties expanding despite the obvious tensions between Israel and Egypt and all other Arab states over the Gaza war, even with the ceasefire? And do you think there's any possibility that Israeli gas could make its way to other markets in the region or perhaps Europe?
Interesting deal, and it should be noted that it was actually initially announced, I believe, in August, but then faced a delay due to the Israeli government, who said that they were holding out for better terms on pricing. But this deal, which apparently was finally, advanced under significant U.S. pressure, has a lot of implications for both parties here. At the moment, Israel doesn't really have another outlet for its gas output other than Jordan and Egypt. And that's partially because it doesn't have the LNG infrastructure to ship its gas to Europe. For that, the only sort of option in the Eastern Mediterranean region is Egypt at the moment. So, Israeli gas flows to Egypt are also an important, destination, or they're an important revenue generator for Israel at the moment, and it will be difficult for them in the short term to really find any sort of alternatives to that. But, for Egypt, the implications are far bigger. At the moment, the country has been kind of trying to pull itself out of a very deep economic crisis while also weathering a, major power crisis as, domestic electricity demand outpaces declining output from its own gas fields. So that has kind of forced Egypt to return to importing largely by, buying more LNG on the spot markets, which is expensive, especially for a country that is, has faced severe financing pressures in recent years. So Israeli gas is the cheapest option for it right now. And so in the short term, Cairo really needs these flows, these expanded flows from Israel. But considering the tensions between the two countries, as well as larger macro trends in the energy market in the future. I mean, this is more of a short-term solution for Egypt. The country needs to build out more of its renewables to kind of offset some of its over-reliance on gas. And at the same time, gas flows from Israel are very important because they will, in theory, allow Egypt to begin re-exporting it as LNG again in small volumes and probably not during the peak summer months. But those shipments to Europe or other customers will actually be very important to Egypt's government coffers, as long as it can manage demand in the other months of the year. But I spoke with an analyst the other day who foresees there could be future tensions and obstacles here with regards to Israel-Egypt energy ties. It's unclear what sort of concessions, if any, Israel was able to extract from Egypt by delaying the deal. We will see if any of those details come out in the future, but it's important to note how much the U.S. role here played in moving this deal forward. Chevron is the operator of major offshore Israeli gas fields, and sales to Egypt are a way to kind of validate its investment in Israel. And at the same time, weeks before the deal was finally advanced, the United States announced a $4 billion LNG supply deal with Egypt that kind of indicated that Washington sees Egypt as being an important player within its energy agenda. And I think that sort of helped pave the way for, both parties to finally kind of agree to move this forward. But either way, it's going to be a major storyline to watch in 2026, whether Egypt can avoid, chronic summer power outages amid peak demand. This is a major political liability for Sisi or President Sisi. And at the same time, even as we are maybe looking at the temperature coming down on some of the regional conflicts, gas flows from Israel to Egypt were also disrupted multiple times due to the Gaza war, as well as the 12-day Iran-Israel war in June. And each time that happened, Egypt was forced to scramble to either shut down certain industries or to buy more expensive LNG shipments. So, 2026, if that can be avoided, then perhaps we see that this deal is working for both. But at the same time, I think the sort of recent tensions between the two show that both probably need to find a way to diversify their energy ties a little bit more.
I have just one more question for each of you. Jack, I want to ask you about energy as well. How much progress do you think was made in 2025 on the energy transition, move away from oil towards renewable energy in the region? And also, are we seeing any movement on that outside of the Gulf?
Sure, yeah. I mean, we certainly are seeing some movement outside of the Gulf. I mean, just some official data which landed yesterday. We've seen in Turkey that solar power has surpassed natural gas as the kind of dominant energy force in its power capacity. So all of the energy which is powering homes and going towards electricity. And that's a milestone for the country in terms of its push towards net zero targets. So Energy Minister of Turkey, Alparslan Bayraktar, said in a statement that Turkey's combined wind and solar capacity reached 39,000, around 39,000 megawatts at the end of November. And so solar alone accounts for about 20% of that energy mix, or 24,669 megawatts of installed capacity. So it's the second largest source in the mix, and it's behind hydropower, which is the leading source, which is around 26.5% of the total, around 32,000 megawatts. So you are seeing it beyond the Gulf. However, the Gulf is leading with this because they have the additional capital to be able to deploy and announce these significant solar projects. And we've seen some really significant announcements. I mentioned Aqua Power earlier in Saudi Arabia. But also there's Mazda, which is the UAE state renewables company, And even I believe they've been announcing some very significant overseas investments. So they announced today, I believe, Southeast Asia's biggest floating solar plant in Malaysia, which is about 200 megawatts. And you've seen significant investments in the last week by the likes of another UAE company called Amir Power, who have partnered with International Finance and Corporation, which is a financing arm of the World Bank to build a giant solar plant in Egypt, which will be one of the biggest solar plants in Egypt and will help the country meet its energy needs. And obviously, Sam kind of gave us a rundown of the dire energy situation in Egypt. So that would be a lot of hope, and hopefully, such projects and announcements will help kind of Egypt move through some of these blackouts. However, we've seen a little less progress from some of the countries in the region. I just point out as well, we had the International Energy Agency previously forecasted oil would peak by 2030, but late this year has revised that to 2050. So that's 20 years extra out. And that's quite a reversal, really. And it's more in line with OPEC's forecasts. And you've seen some countries in the region like Iraq and Iran, Libya, Algeria really heavily rely on oil revenues. For instance, Libya, which has been beset by civil war and conflict between factions in the east and factions in the west, and the Tripoli based government. And you've seen a lot of oil fields being shut down for many years. And this year, we've seen quite a few of the major international oil companies return to Libya, and Libya opening up huge tenders for exploration. And we've seen this in Algeria as well, and in other countries across the region. But yeah, coming back to what we were saying, like, although we've seen progress in some countries, it really is the Gulf countries which are leading the pack because they have the finances to do this, and they can see the vast potential of solar and to make energy cheap. We've seen in Saudi Arabia some of the cheapest energy we've seen ever, actually, on record. I think it was with an Amir Power project in Saudi Arabia, and the Gulf countries also realize having cheap energy will give them the edge in the race for AI dominance when it comes to running data centers, which will be huge energy consumers. So we're seeing a lot more projects being announced, renewable energy projects in tandem with data centers, and I expect to see that trend continue in 2026.
And Sam, I want to ask you about the competition over critical minerals in the region in 2025. What Gulf states do you think are best positioned to be mineral hubs moving into the next year? And also, what's at stake for the US and China in this?
Obviously, you have multiple Gulf states that are kind of interested in carving out a larger role in this industry, but they're kind of pursuing slightly different strategies around it. Saudi Arabia within the region has, the clear sort of focus on becoming a domestic power because it actually has the mineral resources at home to potentially sort of unlock a role in global supply chains here. And they are actively courting investments overseas as well, but alongside trying to push or trying to kind of boost U.S. ties around critical minerals. And we saw that in November when Crown Prince Mohammed bin Salman visited Washington, and they struck a strategic cooperation agreement around critical minerals, as well as MP Materials, a major U.S. critical minerals company or rare earths company, struck a deal with Saudi Arabia state mining company Maiden to build a refinery in Saudi Arabia to process rare earths. And that's actually a very important deal because it will, if it comes to fruition, will firmly cement Saudi Arabia within global supply chains here. Now, turning to the UAE is also actively kind of courting U.S. Cooperation around critical minerals, and we've seen them actually enter a couple of investment partnerships with U.S. players this year to invest in critical mineral supply chain deals around the world. And in the grand scheme of things, these are still fairly minor, and on by themselves, they won't be enough to probably won't be enough to weaken China's grip on, the industry. China still dominates, all of the raw materials essentially that are going to power tomorrow's economy. But it's important that Gulf states are sort of, again, kind of tying their ship to the U.S. on this. Um, and, looking to 2026, and beyond, we'll have to see whether these investments actually, or these partnerships actually turn into real investments, or whether or not this deal with MP Materials and the broader strategic cooperation agreement can actually kind of turn into tangible results. But 2025 kind of demonstrated where the strategy is heading here, and kind of indicated or suggested that Gulf states are going to play a fairly significant role in the Trump administration strategy. And, this was also evident under the Biden administration. So this is something that will probably live on past the current administration, I would imagine. But for China at this point, it's going to take a fairly significant amount of investments from, other players before its dominance is truly eroded. But, for the United States and other Western powers alongside, Gulf allies here, there's plenty of opportunity for them to further boost their critical mineral, capabilities and access. And it's a race against time to kind of do that. But in the short term, the U.S. has to make up ground here. Otherwise, critical minerals will essentially can be held hostage by China. Although there was a recent sort of reprieve in the sort of trade tensions here, wherein China had threatened to, significantly curb restrictions on exports of raw or rare earth minerals. That delay is only for 1 year. So unless there are more sort of suspensions here, this is going to be an issue down the road. So the U.S. has to, the U.S. has a fairly thin margin for error here to kind of, improve its capabilities in this sector while, China still holds most of the cards.
Thank you both so much for your insights and the lengthy discussion, and we look forward to more of your reporting on all things business, tech, Middle East, North Africa in 2026.
Thanks, Adam, and have a great festive period.
Thanks, Adam.
Thanks for listening to the Al Monitor Brief. Be sure to follow Al Monitor for more on the stories impacting the Middle East. Until next time, I'm Adam Lucente.